The troubles at SPH became more apparent last year when it booked its first full-year loss on record. In the first half of this year, it managed to return to the black, but the numbers were hit by the first ever loss at its media business. To improve the company's performance, SPH announced a strategic review in March. It recently concluded the first part of its strategic review. This will see the media business being transferred to a company limited by guarantee, or a CLG.
With the removal, financial performance of the group is expected to improve, while market may also ascribe a better valuation to SPH.
The move still needs the green light from shareholders. If approved, the non-media part of SPH will no longer be bound by the Newspaper and Printing Presses Act. The company will thus be free to pursue strategic growth opportunities for its other businesses.
Post-transfer of the media business, property would be the single largest segment for SPH, and therefore for them to develop and grow in the area of properties, we might see them going more into property development businesses or acquiring more land bank to develop commercial real estate or residential real estate, or even acquire properties to manage them.
The property business contributed 38% of SPH's revenues in FY 2020, up from 31% in FY 2019.
SPH essentially becomes a property player in Singapore. So we all know that this is already a crowded space. SPH needs to articulate how it intends to differentiate this business, from the competition, and how can it overcome the competition.
In the purpose-built student accommodation, or PBSA business, SPH has two brands, Capital Students and Student Castle, operating in the UK and Germany. And despite the pandemic, demand for such student housing remains stable.
Recently, students have come back and they are staying in accommodation, and the countries also encourage the students to stay put, and they will do virtual learning in the accommodation itself. So I understand that the take-up rate for accommodation remains very encouraging.
SPH intends to grow the PBSA segment to become a sizable owner-operator in this space. Aged care is another area that the group has ventured into in Japan and Singapore. In Singapore, it owns Orange Valley, one of the largest private nursing homes.
We think they might expand overseas in more robust aged care markets such as Japan, Australia, New Zealand, or even Western countries. They could essentially buy up aged care assets or buy up management contracts in terms of the aged care businesses overseas. And in Singapore, the government is driving more build, operate, lease aged care centers.
The ultimate goal may eventually be to spin off the student accommodation and the aged care assets into REITs, or real estate investment trusts.
They create recurring income, and if they can, SPH itself as a vehicle can continue to acquire new assets and eventually REIT it, then it will be a multiple REIT manager.
The DOM asset, or the PBSA, has now achieved a decent size with 1.4 billion AUM. So at this size, I think they can do a listing for PBSA. I believe they'll wait, but I think they'll wait for COVID-19 to settle down slightly before doing any corporate exercise.
Among some of SPH's other business ventures is its tie-up with Keppel Data Centres to develop data center facilities. This is the last data center greenfield that is coming up, after Singapore put all data center projects on hold until 2021.
This asset is actually a crown jewel for SPH, given the moratorium imposed on data center currently. They will hold it while realizing value of the asset once it is completed.
They only have a 40% stake in the data center, and they do not have majority control.
With so many possibilities to unlock value, investors will have many questions for SPH before they can make an informed decision.
SPH needs to provide shareholders with a clear future plan. And they need to, notwithstanding that this proposal was labeled as a first step of the restructuring exercise, SPH needs to explain very clearly to shareholders all the reasons why it's doing this.
In the near term, shareholders are taking a cut because SPH is giving 252.3 million Singapore dollars to the media business.
This is cited to provide a soft landing over the next 3 to 4 years, right? Ostensibly, it comes from the minority from the shareholders of SPH at their expense. So this is, similar to ascribing a negative enterprise value to the media segment, which is not the case, as it is still generating some revenue.
SPH fell 15.08% to $1.52 the day after the trading halt was lifted. The shares had been rising to hit a high on April the 16th, ever since the strategic review was announced on March the 30th. Stock analysts who cover the counter remain optimistic that the ongoing review will be beneficial to shareholders in the longer term.
This is only the first step in the ongoing strategic review. I believe there will be more to come, which should be beneficial for shareholders. Without the strategic review, I think the share price could have been still hovering at 120, 130 level.